recession. Did we have one?
Technically, yeah.
Did we miss it?
Yeah, yeah.
Shortest recession ever.
Yeah. So the green line here is real GDP over time, this last 50 years. And you can see these red bands are recessions. So the National Bureau of Economic Research came out in July and stated that the COVID-19 recession actually only lasted 2 months. It was just March and April. That was it. And they just announced that in July. So everybody thought we were in recession for a year or more. And now it turns out it was just 2 months. That's typically how it works.
But wasn't it like we're going to have a Great Depression?
Yeah,
right?
Certainly. Looking back.
Now we didn't have even barely had a recession.
Yeah. The narrative with perfect hindsight is this was sort of a natural disaster type event.
Mm-hmm.
And, along with that, if you look at the trend in GDP, Q2 GDP growth in 2021, the first estimate came out in July and it was up 6.5%. And what that did is it brought real GDP back above pre-pandemic levels. So the economy is now larger than it was before the pandemic and back above the 50-year trend. So, 1 year out and it's sort of blink and you missed it. And there's no doubt that's due to the unprecedented policy response,
right. Yeah,
the fiscal stimulus and so on and so forth.
Zero tolerance for a recession. So if we are taking the position where there's zero tolerance for recessions, what does that do to the economic cycle?
There is a bit of a precedent for that. When Alan Greenspan was able to negotiate a soft landing and he was named the maestro and we thought recessions would never happen again, that was early 2000s type time period. What eventually happened is you build such large imbalances in the economy because there's such excessive risk taking. So people take on more and more debts. They engage in riskier and riskier investment opportunities. The asset prices no longer factor in probability of recession, therefore they are higher.
Mm-hmm.
People use more leverage because they think there's no downside. Anybody running a quant model no longer factors in negative returns, and so you should just always use more leverage and buy more equities.
Right.
And
weaker businesses don't go out of business, and capital does not go to the right places.
Yeah, generally, productivity falls.
Mm-hmm.
So it always breaks eventually. It would just be it'd be really big when it did.
Which is what we've seen periodically, right? I mean, without this unprecedented stimulus, we would have had a really big recession.
Yeah. It would have been really nasty. I mean, you have record levels of corporate debt pre-pandemic, and that was, that all came into question during the pandemic. And that's why the Fed had to react as strongly as they did.
Taper? No taper?
Will
they ever be able to taper in reality?
They're certainly going to try to taper, but our view is first you have to say you're talking about tapering, and then you have to actually start tapering, and then you're going to do it monthly. And at each point you're taking the market's temperature. And, at the end of the day, someone has to buy the treasury bonds. If the Fed's not doing it, the banking system is not set up to take down all the treasury issuance that's coming. And so the banking system will need support from the Fed at some point. So they'll try, but if, it goes back to the chart of Fed assets. It's higher highs and higher lows.
Right.
We're never going to get back down to something like a, $3 trillion Fed balance sheet.
No.
I mean, I'd be surprised if we dip below 8 trillion ever again.
Yeah. We're at 8.5 trillion now, or pushing 8.5 trillion. So,
yeah. So
rate hike expectations, similar to tapering, they've really come down.
Yeah.
So
a lot.
So let's take a look at this chart and talk through the change in just a few short months.
Yeah. The green line, what you're seeing there are the long-term expectations for changes in short-term interest rates. 3 years out, 5 years, 7 years, 10 years. And that's as of the end of July. Versus the blue line is where we were in April.
Yeah.
So, you really have to look far out into the future because over the next 1-2 years, the outlook for rate hikes hasn't really changed. And by the way, over the next 1-2 years, the Fed isn't really going to hike much at all. So the expectations only really start to change when you talk about long-term, how high can the Fed get short-term interest rates in this economic cycle? And from April to July, if you look at the 5-year number, went from 205 to 134. So came down 0.7% just in those few months.
Yeah.
So, and this is, this is the consensus of the bond market 5 years out. That's a huge move, a huge move. The entire market saying there's no way the Fed gets short-term interest rates back to 2% in this economic cycle. There's no way.
And so we titled this slide Delta variant. So there's some impact of that, but what's the other big underlying factor there of why this probably is occurring?
Yeah, that's what you'll probably see in the news, if this gets covered at all. Yeah. But in the financial media, it's the Delta variant, it's concerns about economic growth,
slowdown,
et cetera.
Lockdowns, et cetera.
The other narrative here is when you're looking 5 years, 7 years, 10 years out, this is a global market for short-term interest rates in the U.S. This reflects the global view of the cost of money long-term. A lot goes into that, a lot more than the Delta variant. This is folks that are very intelligent that are saying, I'm willing to park my money for very little for a very long time. It does not bode well long-term for economic growth. Right. This is where things like, how fragile really is Chinese economic growth, things like that, all that factors into here. So, there's totally another side to this narrative that probably won't get covered in the financial media that speaks to the global monetary system and the imbalances and the fragility of it. Mm-hmm. That after we get through this big economic boost that we're getting post-COVID, we're probably going to be spending a lot of time talking about.
Right. Yeah. Thanks to our research team for all these great slides. And as always, if you have questions, let us know, and we'll talk to you next month.
Thank you.